Now we look at some of the economic impacts of all of this. The day's business news. Brian Quinn is with us today. He's starting with a check on the markets, vital markets today, still in turmoil, really, over the US and Israel's war in Iran.
So, Stuart, European indexes are starting to recover a bit after losing around 3% on average in Tuesday's session. All sectors sold off yesterday. Travel shares especially taking a beating. That sector is recovering a bit at Wednesday's open. The CAC 40 here in Paris up 0.25%. The DAX in Frankfurt gaining around 0.4%. The big story on markets Wednesday, though, is Korea. Its main stock index, the KOSPI, closed down more than 12%. That's the biggest one-day crash since the 2008 global financial crisis. Trading briefly halted as chipmakers like SK Hynix and Samsung marked drops of 9.5% and nearly 12%, respectively. The two electronics giants together make up nearly half of the KOSPI's total value. And Korean stocks had been on a huge winning streak, gaining more than 75% last year as the AI boom inspired retail investors to pile into equities. Korea, though, imports nearly all the energy needed to power those chip makers. Analysts say rising oil prices due to the war in Iran are likely to hit the country especially hard. Take a listen here.
To be in an era of fresh energy volatility, just at a time when there had been hopes that energy prices would be coming down. It's adding fresh pain for households and companies around the world. Certain countries will be more exposed than others, and I think we're going to see this playing out in the days to come. But ultimately, it is the risks of conflict continuing to escalate with no end yet in sight that is really concerning investors and why you're seeing this financial market reaction.
Now, meanwhile, some news that came into us a couple of hours ago now. Iran's Revolutionary Guards, they are saying that they have complete control over the Strait of Hormuz, a crucial, of course, choke point for oil exports from the Persian Gulf region. What are we seeing in the oil markets, Brian?
Well, Stuart, crude prices are still on the rise Wednesday, though not as much as on Tuesday when we saw some massive spikes. A European benchmark, Brent crude, currently up around 3% to trade around $83.83 a barrel. America's West Texas Intermediate up around 2.75%. Brent and WTI had each surged by around 9% on Tuesday over fears that the Strait of Hormuz could be closed indefinitely. Some 20% of the world's oil and gas is transported through the waterway that connects the Persian Gulf to the Gulf of Oman. Shipping firms got some relief, though, when President Donald Trump announced that the U.S. itself would provide reasonably priced insurance for cargo ships traveling through the Gulf, adding that the U.S. Navy could even begin escorting ships through the Strait of Hormuz. Operating costs for the supertankers that carry oil from the Middle East to global destinations have nearly quadrupled since the start of the war, hitting around $425,000 per day. Most countries, including France, have strategic oil stockpiles to last several months. The question for prices, though, is how long the disruption will last.
If the stockpiles were to be depleted with regards to oil in the next few weeks, and no more production can leave that area in the Middle East, then we could definitely see higher oil prices because we're still needing the same amount of oil, but there is less supply out there. And that could then lead potentially to the Brent price, which is already up at around $80 per barrel, to rise to $100, even $120 that we have seen a few years ago.
And finally, for business, the shutdown of airspace across huge parts of the Middle East is being called the worst crisis for air travel since the COVID-19 pandemic.
Tens of thousands of people sort of stranded around the Gulf region, and hundreds of thousands more are in similar situations worldwide, with their options to return home either canceled or too expensive to afford. Meanwhile, companies who've made the region one of the top global travel hubs are beginning to suffer. Luke Schrager reports.
A now familiar sight around the world. Crowds of passengers stranded in airports, looking for ways to get home as the war in Iran continues to rage. It's one of the worst blows possible for trust in the travel and tourism industries.
It's a shame that the handling of this isn't being managed very well. The airlines aren't really giving any solutions, and it needs to be addressed.
It's not just tourists either, but those who rely on travel for work, particularly in developing nations who've now seen their source of income disappear.
We are remittance earners. We go abroad because our families need us to, and we can't do anything here at home. We can earn some money abroad.
The reputational damage from the cancellation of over 20,000 flights through the Middle East and counting is hard to calculate. Regional tourism is worth around $367 billion a year, with countries like the United Arab Emirates and Qatar investing deeply in becoming global aviation transit hubs for decades.
Within the Middle East, an 8-hour flying distance covers 2/3 of the world population. So it is a strategic corridor in terms of being able to move west to east. 20 to 30% of the world's travel and trade goes through that corridor. When it comes to global travel especially, trust and confidence are the main currencies, and this has broken that.
Middle Eastern carriers are now seeing bookings in freefall as travelers seek alternatives, and that's on top of a potential shock from surging oil prices. Delta Airlines stated in its latest filing that a 10% increase on jet fuel would add $1 billion to its annual fuel bill.
So some tough days ahead for the airline sector, especially as the busy summer travel season starts to get underway, Stuart.
Brian, thanks a lot, Brian, with business. Straight